Hey everyone, welcome back to Corporate Decoder, the place where we try to figure out if companies are playing by the rules or just making up their own. You might be surprised by what we found in this latest filing. Today we are diving into Empire Petroleum Corporation's latest report, a really interesting document where they update us on some key business changes. Forget the boring legal stuff. We are going to focus on what actually matters to this company's future and whether their deals are a smart move. Before we jump in, if you are a fan of cutting through the corporate jargon to get to the real story behind the numbers, hit that subscribe button and the notification bell so you never miss an update. We also have a growing community on Discord linked in the description below where we chat about these filings in real time. Alright, let's get straight to it. This filing is mainly about a new agreement Empire Petroleum Corporation, we'll call them EPC for short, has made. It is an update to a previous deal involving a guy named Philly Mulasek and a big chunk of money. So, back in September, EPC made a deal with Mr. Mulasek where he agreed to lend them up to $4 million. They've already gotten $2 million of that, and it is set to be paid back in September of 2027 with a 5.5% interest rate, which is pretty standard. The really interesting part is that Mr. Mulasek could lend them another $2 million later on, but it is up to him, and only if everything is going well with EPC. Now here is where it gets spicy. Mr. Mulasek has the option to turn that loan money, or parts of it, into EPC stock. The price for this conversion was initially set at $4.27 per S-hair, and as a little bonus for him agreeing to this deal, he also got warrants to buy even more EPC stock at that same price. Warrants are like options, giving him the right to buy stock later at a set price. But as of the 5th of November 2025, they signed a new agreement called a letter agreement that changes the game a bit. First off, for any future money Mr. Mulasek might lend, EPC can ask for it, but he still gets to decide if he actually gives it. It is his choice. The price at which Mr. Mulasek can convert the first $2 million he lent has gone up slightly from $4.27 to $4.32. This means EPC is worth a tiny bit more to him if he converts now. Also, the number of shares he could get through his original warrants related to that first $2 million loan has been reduced. He is now going to get fewer shares than originally planned, dropping from about 281,000 down to around 139,000. That is quite a bit less. Now, for any new money he might lend in the future, the conversion price is going to be based on the company's stock price right before he gives them the money. It is going to be the average closing price for the 5 days before the advance. This is a more market-driven approach. And if he does lend more money, he'll get new warrants tied to that new money, with the exercise price set by that market-driven price, and the number of shares will be determined by a calculation involving the amount of the advance and that price. It is a way to give him equity that is more directly tied to the current value of the company at the time of each new advance. So, to recap the changes to the warrants specifically for that initial $2 million, the price to buy the shares went up a little, and the total number of shares he can buy went down significantly. There is also a cap on the total number of shares Mr. Mulasek can end up with through all these conversion and warrant rights. They can't issue him more than about 1.2 million shares in total, no matter how much money he lends or converts. This is a crucial limit to prevent dilution of existing shareholders. Now, what does this all mean for EPC and its investors? Essentially, they've renegotiated terms with a key lender. The reduction in warrants offers some relief to existing shareholders by limiting future dilution. However, the slight increase in conversion price and the more market-driven approach for future advances suggests confidence in the company's value, or at least a desire to tie future equity dilution more closely to its current market worth. The overall cap on shares is a positive sign for control and preventing excessive dilution. This next section just confirms that these agreements create financial obligations for EPC, which is to be expected with any loan or convertible note. It is mostly a formality, and the details are already covered in the previous section. And finally, as is standard, they list the exhibits that are part of this filing. This includes the actual letter agreement, which is the key document we've been discussing, and the interactive data files that help make these reports more accessible. The most important exhibit here is Exhibit 10. The letter agreement itself. This is the document that lays out all the nitty-gritty details of these changes, and it is definitely worth a look if you are a serious investor. So, what is my take on this? Empire Petroleum Corporation is clearly in a phase where they are securing funding and managing their relationships with key financial partners. The amendment to the agreement with Mr. Mulasek shows a company that is actively working to refine its financial arrangements. The decision to reduce the number of warrants and increase the conversion price slightly on the initial advance seems like a good move for shareholders concerned about dilution. It means that for the money already received, the potential for new stock being issued is less than before. The move to a market-based conversion price for future advances is also an interesting strategy. It can be good because it means any further equity issued will be more in line with the company's current valuation, preventing them from giving away stock too cheaply if the price rises. However, it also means that if the company's stock price is volatile or drops, the cost of new capital could become more unpredictable. One of the biggest pieces of good news is the cap on the total number of shares Mr. Mulasek can receive. This puts a ceiling on how much dilution existing shareholders might face from this particular arrangement, which is crucial for maintaining shareholder value. Overall, EPC appears to be navigating its financing by trying to balance its need for capital with the desire to protect its existing shareholders from excessive dilution. The risks here are tied to the company's ability to grow its valuation to a point where these conversion options and warrants are attractive to Mr. Mulasek, but not so attractive that they cause massive dilution of existing shareholders. The opportunity lies in their ability to leverage this funding to execute their business strategy effectively. Alright? That is our breakdown of Empire Petroleum Corporation's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think these amended terms are a win for shareholders or a sign of something else? Drop your thoughts in the comments below if this analysis was valuable and helped you understand what is going on behind the scenes at EPC. Hitting that like button really helps us out, and subscribe for more dives into corporate filings, and don't forget to join the discussion on our Discord server linked in the description. Thanks for watching, and we'll see you next time on Corporate Decoder.